Good afternoon, everyone. Thank you for joining us on this Wednesday afternoon. I know everyone's busy, so I appreciate you taking the time to listen to us. We got a great presentation today. Everyone asks about this topic all the time, so we have a great presenter and a great topic. So I'm going to jump into it, but before I introduce the speaker, just a few things. Everyone will be eligible for one CPE credit for participating. You must answer the 3 polling questions to confirm your participation. And also, everyone's in listening mode, but please type your questions into the Q&A panel at the bottom of the computer. And without further ado, we're going to start the presentation. We have Mark DeMichael from Citron Koopman, who's our presenter. Mark is a partner in our forensic and litigation evaluation services and has extensive knowledge in the digital asset area, blockchain, and Bitcoin. Mark talks about this topic all the time, and he is a wealth of knowledge in this area. So without further ado, Mark.
Thank you, Pat. So we're going to jump right into it. Polling question number 1 before I get started. If you could just please answer polling question number 1, that will help make sure you get your CPE credit. Okay, I'm not sure how long I'm supposed to pause here, but I'll move on. Oh, there we go. Polling 52% are interested. Very good. Okay. On to our first slide. Now, I know a lot of you may be fairly knowledgeable about this topic by now. Bitcoin's been around for a number of years and it's been gaining in popularity. So I'm going to be brief, but I am going to go a little bit into explaining what it is, how it works, just to make sure everybody's on the same page. Bitcoin goes back to 2009, but the origins of it actually go back to the 1990s. There was a group of people that created their own version of money that they could use on the internet, and it wouldn't involve any governments or banks. That was the main goal. They were trying to eliminate the government from the monetary system, basically. And they tried to do that back in the 1990s, and they couldn't get it to work because of something called the double spending problem. And they couldn't solve that problem in the 1990s, so they gave up. And nothing happened for quite a while until Bitcoin came around in 2009, which successfully solved the double spending problem using something called a blockchain. The main thrust of that is that the result of this, the reason this is worth money and the reason this is still going and that Bitcoin has legs, is that the blockchain technology is actually capable of eliminating or reducing third parties from financial transactions in a lot of different ways, and that saves on cost. So that's why this is such an interesting area, and that's why there's value here, and we'll talk more about that a little later. You may hear a couple different terms when referring to Bitcoin and crypto assets. You might hear the term cryptocurrency. You might hear the term virtual currency. You might hear the term digital assets, crypto assets, virtual currency. Those all basically mean, for purposes of this presentation at least, they basically mean the same thing. There's some nuance between those terms, but it's for purposes of what we're going to go through today, you can just think of those as basically the same thing. It's Bitcoin and the other cryptocurrencies like it that have been created since. And there are many cryptocurrencies besides Bitcoin. There are, in fact, thousands of cryptocurrencies out there. So I'm going to talk a little bit about Bitcoin works. And most of this technology applies to the other cryptocurrencies that exist as well. They're all running off the same basic concepts. Okay, so I mentioned before the double spending problem that was back in the 1990s they had when trying to create a currency that doesn't rely on banks. The problem is this double spending problem, and it's exactly what it sounds like. Here we have a bank, and there's 3 customers of the bank, 3 depositors. Scott here on the bottom left has $5,000. Mary has $2,000. Rosie has $12,000. If Scott tries to write a check for $5,000, and then he writes a second check for $5,000 and he passes those checks off to third parties, there's a problem. And if both of those checks are paid, that's a big problem because the bank is going to be out the money. What the bank does is the bank will mark one as insufficient funds. Doesn't matter which one, whichever one gets paid first will get paid. Whichever one comes in second won't get paid. But as long as the bank does that, the bank is okay. The monetary system is okay. One person had a bounce check, but it's not a major problem. When cryptocurrency came about, or when they tried to do this back in the 1990s and create this virtual currency, they didn't have a good solution for preventing a double spend like that, because as I mentioned, they were trying to keep the bank out of this system altogether. So they eliminated the bank. This is the Bitcoin system now, and they replaced the bank with something called miners. And miners are computers around the world that keep a copy of something called a blockchain. And the miners are the ones who would process transactions and make sure Scott doesn't double spend his $5,000 here. But we're not talking dollars anymore, we're talking Bitcoin. So Scott and Mary disappear and they're replaced with addresses. And now address number 1 has 2.4 Bitcoin, address number 2 has 85 Bitcoin. These are the same people as before. This here is Scott on the bottom left, but no one knows who Scott is. Miners don't know who Scott is. The way this system works is that Scott can control his 2.4 Bitcoin and spend it by using something called a private key. It's a password basically to spend Bitcoin. If Scott loses his private key, Scott can't spend his Bitcoin anymore. If Scott's private key is hacked, the hackers will be able to spend Scott's Bitcoin. That's the way the system works. It's kind of like cash, right? If you lose your $20 bill, there's no help desk that you can go to and say, oh, I lost my $20 bill. Can you refund me? That doesn't exist. Not for cash, same for Bitcoin. So you can think of it that way. This next slide is a visualization of what a blockchain is. As I mentioned, the miners in this last slide here all have a copy of the blockchain. When you think of a blockchain, just think of a long transaction record history. Basically, the blockchain for Bitcoin shows every Bitcoin transaction that ever occurred since 2009 when Bitcoin first started. There's a separate blockchain for each cryptocurrency. But that's all a blockchain is. It's just a long transaction history. And it uses computer science and cryptography to make sure all the miners have an identical copy of this same blockchain. That's basically the way it works. As far as what the users do, as I mentioned, they have private keys, which is basically a password for spending your Bitcoin or other cryptocurrency. There's a few different ways to keep your private keys. And these private keys are about 64 digits long. So you're not going to be able to successfully remember your password or private key when it comes to cryptocurrency. So you need another way to keep track of it. One way to do it is something called a software wallet. A software wallet is simply an app on your phone or an app on your computer that will maintain your private keys for you. The risk of using a software wallet is that your phone or your computer could potentially be hacked. And that would be concerning because someone using a software wallet could potentially lose their Bitcoin. So there's other alternatives. One is called a hardware wallet, like this. This is called a Trezor. This is a hardware wallet. You will notice it is not plugged into a computer anywhere, but it has a little USB port on it. So were I to keep some Bitcoin on there, I could plug it into the computer when I want to make a transaction or plug it into my phone. And then when I'm done, I unplug it. So the keys remain on there, safe from hackers. And it's also convenient and easy for me to use because I can just plug it into my phone whenever I want to send some Bitcoin. The next option is a paper wallet. And an example of that is right here. This is an example of a paper wallet. It is simply a piece of paper that has a private key written down or printed on it off a computer. The advantage of that is it's safe, good for long-term storage, But if you actually want to transact in your cryptocurrency on a regular basis, it's really impractical. The final way to hold on to cryptocurrency is to avoid that altogether. Skip the keys, skip the wallets, and just use an exchange or a custodian. That's basically introducing that third-party bank or brokerage account back into the mix. Instead of you holding your own keys personally, you have a third party hold your keys for you, and that's it. You just keep a password with your custodian or your exchange, and if you lose your password, you just call the exchange up and they can reset your account. It's basically using just an account and password type situation. There's a help desk. I'm sure you're very familiar with it if you have an online account with your bank or your E-Trade account. An example of a exchange is Coinbase. That's the largest US-based digital asset exchange. There are dozens and dozens of exchanges out there that will handle your keys for you and will also make it easy to trade and buy Bitcoin, sell Bitcoin, or trade for other cryptocurrencies. That's it. That's all I'm talking about for what it is and how it works. I'm going to answer the question here before I move on. If any of you have other questions about what it is and how it works, throw it in the chat now. I'd rather answer it now rather than you folks be confused and not understand what I'm talking about going forward. So the question is, can an exchange be hacked? And the answer is yes, they can. And they, in fact, have been in the past. There have been a number of hackings. Some have been very large and high profile in the past. It's sort of anytime you give an asset of yours to a third party, like a bank or a Bernie Madoff or an investment advisor, you're trusting that investment advisor or that third party with your money. And if they screw up, or if it's a Bernie Madoff that you've entrusted with your money, they can run off with it. So yes, exchanges can be hacked. Anytime you don't custody something yourself, you're running the risk that that third party runs off with your money. That's exactly why the creators of Bitcoin tried to keep third parties out of their financial transactions. So it's entirely possible. And, yes, hackings do happen. What generally happens when there's an exchange hacking is usually not all the funds are taken, but usually a small portion of the funds are taken, 1 to 2%. That's because the exchanges will have security measures in place to make sure there's not major losses of value. And when that happens, the exchange will either make the users whole out of their own pocket, or if they can't afford to do that, all of the users will take a haircut, as it's called, and everyone will lose their money proportionally, basically. We have a lot more questions, so I'm going to make sure I get to your questions, and we'll get to the other material, I'm sure, later. I'm sure we'll have enough time. How and why are crypto tokens burned? Okay, the term, well, let me go back to the first question, actually, because I'll go in order. Are the exchanges insured? Yes, some of them are. It's up to the exchange as to what insurance and how much insurance they're going to keep. That's entirely up to the exchange itself. I'm sure each exchange probably has a user agreement or policy or something that I'm sure you can look up online, but the exchanges can and sometimes are insured. They'll often sometimes create a separate, it's called a SAFU fund, that they keep money separate just to make sure that if there is a hacking or something goes wrong, they can draw on those funds to reimburse their users. If the goal was to eliminate the banks with your cash, it looks like that question, whoever was typing that question didn't quite finish. So I'm not sure, Henry, I'm not sure what you're asking. If you want to retype it, I'll give it a try to answer that question. Can a wallet be hacked when it's attached to a computer? So if I assume you're referring to one of these hardware wallets, they're designed not to be hackable. It's theoretically possible, but these are considered within the cryptocurrency industry and within the community to be pretty darn secure. So even if you do attach it to a computer, it's designed to not be hacked. And it's specifically designed to only really create cryptocurrency keys and store them. That's all it does. So it's harder to hack it from a technological standpoint because it's limited in what it could do. It's like if you tried to hack into your calculator if it were hooked up to an internet, your calculator can't do that much. So you have limited ability to hack into it because it can't read computer code to begin with. So they're designed to be very secure, but theoretically they could be hacked when they're plugged in, which is why you generally unplug it. Next question, how much are the fees to use an exchange? Generally, if you're going to make a trade, anywhere from 0.5% to sometimes up to 1.5 or 2%. It depends on a number of factors, how much you're trading, how often you're trading. It's a little more expensive than stock trades because it's a little less commoditized at this point. I'm sure fees have been going down, and I'm sure there will continue to go down in the future, but it's usually 1 or 2%. If Coinbase, the example I gave before, I think they're about 1.5%. Can you spend Bitcoin through the exchange? Yes. So once you buy cryptocurrency on an exchange, you can then send it off exchange. You can send it to your own hardware wallet or your own paper wallet if you want to keep it yourself, or you can send it to someone else's wallet if you want to enter into a transaction. So yes, they can be spent directly off an exchange. How and why are crypto tokens burned? So the term burned, that basically means destroying a crypto token, taking a Bitcoin and sending it to an address that nobody has the password for, or there are other potential ways to burn crypto tokens. It basically means destroying a cryptocurrency unit. There are a number of different reasons to do it. Some people will just do it as a test to see if they can do it. Other times, companies will often create their own cryptocurrencies. I'll talk more about that a little later. But when they issue these cryptocurrencies, they're issuing them to customers and or investors. And any asset, including cryptocurrencies, has a supply and demand aspect to it as far as pricing. So if a company that issued its own crypto token wants to increase the price of that crypto token, they might burn or destroy some of those crypto tokens. That's, I'd say, is the most common reason for burning crypto tokens. It's usually to have an impact on the price in some way. There are many different types of crypto tokens. I'll talk about that a little later. Sometimes a community of users might vote to destroy crypto tokens for that same reason, to cut the supply. That's generally the reason it's done. How is a Bitcoin a currency versus a security? Okay, Bitcoin is considered a commodity from a legal standpoint. It's not considered a security. The Securities and Exchange Commission is the group that is the ultimate arbiter. Well, actually, the ultimate arbiter of whether an item is a security or not is the legal system, the courts. The Securities and Exchange Commission is the regulatory body that is supposed to regulate securities. So what generally happens, at least with these new cryptocurrencies that are being created, is the Securities and Exchange Commission will say, oh, we think this cryptocurrency is a security, therefore it falls under our jurisdiction and we're going to regulate it, or we're going to sue the creators of this cryptocurrency because they're selling an unlicensed security. That's actually happened. The SEC started a lawsuit against I think it's the 5th largest cryptocurrency by market cap. It's called XRP. The SEC started a lawsuit against them, and that lawsuit is currently ongoing. There's a 4-part test to determine if something is a security or not. It's called the Howey test. I'm not going to go into great detail on that. It's a little beyond the scope of this presentation, but that's the Howey test, is how something is determined to be a security or not. Next question. What is it that miners actually create? So the miners in the Bitcoin ecosystem, as I mentioned them before, they're processing the Bitcoin transaction. So they're not creating anything so much as they're really performing a service to process cryptocurrency transactions. Cryptocurrency transactions are created not one at a time, but they're grouped into blocks. So one block might have 2,000 Bitcoin transactions in it. And each new block is added to the blockchain. That's the transaction record that I mentioned. So whenever a mining computer creates a new block, and that block is deemed to be a valid block with a valid grouping of transactions, a new block is added to the transaction register, the blockchain. The first entry in that new block is a miner awarding themselves 6.25 new Bitcoin, Bitcoin that didn't previously exist. That's how the miners are rewarded for their transaction processing services, basically. So when a miner creates Bitcoin, they're just putting a plus 6.25 additional Bitcoin onto the transaction record. So creating Bitcoin is simply an entry on a ledger. That mining reward of 6.25 Bitcoin used to be higher, and every 4 years, it used to be 50 Bitcoin. Every 4 years, the amount of Bitcoin that is rewarded for a new block gets cut in half. That's what's happening. Do you personally own crypto or digital assets? Yes, I own some, not a lot, because it's a very volatile investment. I would not recommend anybody put all your savings into crypto or digital assets. That is a very bad idea. You should have a properly diversified portfolio. I'm not a financial advisor, but I just know that's good advice. And if you're going to buy assets that are really volatile, in general, you're supposed to do that with a very small percentage of your assets. Next question. If an exchange has insurance, can an individual still get a haircut? Well, I think that's a it's going to depend case by case. If the exchange has enough insurance, I would say no. Generally, the clients and the customers generally should not lose a portion of their Bitcoin. I would think the insurance company would make them whole. But if there's not enough insurance, or there's a high deductible of some kind, or maybe the insurance company deems this hacking is not covered for whatever reason, you know, insurance companies, in that case, individuals could still get a haircut. It's going to depend case by case. Getting more questions in, more questions. Okay. Does a wallet require a password to help prevent it being used if stolen? Yes, the wallets, each one of these is different. Like this is a Trezor, this is a SecuX, this is a Ledger. I think all three of these require passwords, but if there's other wallets out there, and that there are other wallet hardware items out there, I don't know that every one necessarily requires a password, but the way this one works, the Ledger, for example, it has a password you need to enter in, 5 to 8 digits, I believe. If you enter the password wrong 3 times, the wallet resets. So that's a security measure to keep it safe. And if your wallet resets, there's something called a backup seed that you could use to reestablish that wallet, basically. As long as you keep your backup seed, even if your wallet is lost or stolen, everything's okay. The coin is not a currency, it's more like a security. That's another question. It doesn't look like it's fully written it out. How is Bitcoin a currency versus a security? I'm not sure. Let's see. Currencies are not volatile. Bitcoin are very volatile. Generally, that's true. There are some currencies that have been more volatile than others. Venezuelan bolivars have been experiencing something called hyperinflation recently. So I'd say generally currencies aren't volatile. Bitcoin was originally called a cryptocurrency. For the most part, people aren't using it really as a currency. I'll talk more about that a little later. When will regulation begin in the crypto space? Well, I'd say regulation has already begun. There's a number of regulations out there that apply. I gave an example before, the Howey test. I talked about the SEC. Will there be further regulation in the future? seems like there will be. I hear a lot of politicians and regulatory agencies talking about increasing regulation. Okay, moving on. I think I got through all the questions now.
Keep the questions coming. As you can see, Mark is a breath of knowledge in this area. You know, he really knows the industry and the topics. So please keep the questions coming because, you know, everyone's learning by everyone's questions.
Thank you, Pat. Yeah, I'd rather get to your questions than get to my slides. If you have questions, I want to give you answers. Can you use limit prices when trading? Some exchanges have limit prices, some don't. That's the best I can say. Like Coinbase does not, but Coinbase Pro does. So it depends exchange by exchange. Next question, why does Bitcoin adoption take so long? Do you personally see it as groundbreaking or good technology? Well, any new technology takes a long time to develop and become adopted. I personally see it, yes, I do personally see it as a very good technology and groundbreaking. And that's why I'm kind of gearing my career and spending a lot of time working in a cryptocurrency field. Even though it's risky, I do think this has legs. Okay, so let's talk about value, because I get this question a lot. Why is crypto worth anything at all? Just checking time here. One advantage it has over regular other types of money is decentralization. There's no single point of failure. If you put your money with a bank and that bank fails, or you put your money in a stock and that company fails, you're out of luck. With Bitcoin, there's no way for it to truly fail. As long as there's at least one mining computer out there, the system will still work. Even if like China recently said mining not allowed, and they've banned all mining, and all miners in China should have been or in the process of shutting down. Doesn't matter. There's miners in countries all over the world. So there's no single point of failure. That has some value to it. Bitcoin is commonly seen as a store of value because it's scarce. There's a limited supply. There will only ever be 21 million Bitcoin created. That's built into the Bitcoin computer code that all these miners are running. So scarce assets with a limited supply tend to be more valuable than assets that can just be printed more of. Like, for example, the US dollar, they could print more dollars if they wanted. Not the case with Bitcoin. Integration into the digital economy. It seems like more and more transactions and more of our economy in general is becoming digital. It's happening online. It's happening electronically with email and on websites. Bitcoin can be integrated directly into that because it's purely digital by nature. An individual can link their wallet up to an app, and every time they watch a video on that app, their wallet will be automatically debited to pay for that video. That can be integrated automatically. Without Bitcoin, you can still do it, but you need payment processors. You need Visa, you need MasterCard. The recipient needs a bank or a payment processor to accept the payment. That adds cost. Bitcoin can be integrated for free using computer code, basically. Next item, instantaneous, secure, low-fee money transfers around the world, and the possibility of microtransactions. So again, the efficiency of having a purely electronic currency that can move with computer code can make things extraordinarily efficient, extraordinarily cheap. So in the past, if you wanted to create a business where you're charging customers pennies for a transaction, or maybe a fraction of a penny, maybe I want to charge a customer 0.26 cents per megabyte of data storage, right? You couldn't do that in the past because you need a payment processor to handle these transactions. There's added costs. But if you wanted to do that with cryptocurrency, microtransactions, very, very small transactions, become possible. If you want to send a wire transfer around the world, banks charge 30 bucks, something like that, for a wire fee. With cryptocurrency, there's the potential to do it for a lot less. Bitcoin fees and Ethereum fees, those are two cryptocurrencies, happen to be very high right now, but there are many other cryptocurrencies that are much, much cheaper, pennies or fractions of a penny for a transaction. Also, globalization is another benefit of cryptocurrency. As I mentioned, the world's becoming more digital, more global. Bitcoin has no borders. It can move freely between countries. Nothing can be said the same for any specific fiat-based currency. US dollars tend to be associated with the US. Euros tend to be associated with Europe. There's a global nature to this that makes it somewhat more valuable. Privacy. Cryptocurrency can be moved around in a pseudo-anonymous fashion. I say pseudo-anonymous or semi-anonymous because it is possible to trace cryptocurrency, and that's a large part of what I do, is tracing cryptocurrency transactions for litigation purposes, divorce purposes, criminal investigation purposes. It's traceable, but it's very hard to trace. So a lot of individuals find their privacy very important. Some of those people are criminals. Some of those people are just more privacy-minded individuals. That has value, and that's part of what gives cryptocurrency its value. And then finally, investment income and speculation. If people see the price of something increasing, they want to jump on the bandwagon, so they'll buy. So that, I think, has been a part of the price of cryptocurrency as well. It's a wide range of factors here that are going into this. No more questions. I see some talk in the chat. And looks like some of those are questions, so I'm going to answer those real quick. Let's see. What are the big differences between Bitcoin and Ether? I'll talk about that a little later. A Bitcoin is just a Bitcoin. Ethereum is capable of running smart contracts and NFTs and DeFi. I'll talk about all of that later. How will the introduction of crypto EFTs affect the overall market? Stabilize or more volatile? I don't know the answer to that question. It's all a function of supply and demand. I would think a larger grouping of participants participating in any market in general, more participants means less volatility in general. With the creation of new cryptocurrency, how would this play into the future? Meaning, won't one crypto remain the most valuable, making the remaining cryptocurrencies less valuable? Well, it's the same laws of economics as anything else. If there's a lot of competing products, if you're making widgets and there's a lot of other people making widgets, well, yeah, you need to compete on price, so the value of your widgets would have to go down. So yes, more cryptocurrencies could potentially mean less value for any one particular cryptocurrency. In general, same way any industry grows, in general, when there's a new industry, you normally have a very large expansion of market participants in that industry. So, once cars were introduced, there was maybe one or two companies making them, and then there was probably hundreds of companies making them. And then over time, as industries become more mature, they tend to consolidate. So, one automaker will buy another, and you start to get pseudo monopolies or monopolies forming. That is what has happened in every new industry that ever happens. It's called an industry life cycle. I see the same thing playing out with cryptocurrencies. We started with one. We have over 10,000 cryptocurrencies now. And I think maybe one day you'll start to see consolidation, but that's not happening right now. At the current time, isn't Bitcoin still tied to the standard currency? If you use Bitcoin, I imagine you'd need to buy it using standard currency. Not necessarily. You could earn Bitcoin for goods and services, right? I could perform accounting services and say, pay me in Bitcoin. Someone could sell you a widget and ask for payment in Bitcoin. Generally, when people are setting prices right now, no one's setting the price in Bitcoin because it's too volatile. Next question, how many Bitcoin have been created to date? What will be the miners' incentive once they're all created? There's currently, I think, around 19 million Bitcoin out there. The cap will be 21 million, and those will be mined over the next 120 years or so. Once all of the Bitcoin have been created, the miners will still be rewarded with transaction fees. So anytime you send a Bitcoin, you have to pay a mining fee. So the miners will be incentivized to continue their work. They'll just be incentivized with less Bitcoin. But theoretically, the hope would be that the Bitcoin price would raise, so it's still sufficient to keep miners mining. All right, this is great. I'm getting a ton of questions. Are stable coins really stable? I would say yes, for the most part. There's a stable coin is a cryptocurrency that is designed to keep a more stable value. So other people were talking in questions before about how cryptocurrency is volatile, and I was talking about that myself. The Bitcoin price is very volatile. Well, there's other cryptocurrencies out there that are designed to have a stable price. One example is something called USD Tether, and there's another one called USDC, USD coin. Those are designed to be worth $1. They are generally backed by other assets. They should, what those other assets are can vary. Some of them are backed by dollars in a bank account. Others are more backed by a basket of assets, a basket of investments. They're designed to maintain a stable price of $1. In general, so far so good. USD Tether usually ranges in price from 99 cents to $1.01. So that seems pretty stable to me. There's been very limited instances where it breaks outside of that range. I think it went as low as 90 cents one time. But for the most part, they're pretty stable. So far, so good. What about the 6% issued when a new blockchain event occurs? How does this tie into the 24 million max number of coins? I don't understand that question. The cap for Bitcoin is 21 million, but there is no 6% issued when a new blockchain event occurs. I don't know what that's referring to. If you could be a little more specific, I'm glad to answer the question. How many different cryptocurrencies are there, and do you see any of them besides Bitcoin will become used in the mainstream transactions? We'll talk about that a little later, actually. I'm going to skip that question. How does one convert from one cryptocurrency? How does one convert from crypto to USD? Generally, that's done on those same exchanges where you'd buy cryptocurrency. So instead of taking US dollars, transferring it to Coinbase and buying Bitcoin, that would be your first step. But say you make a profit and now you want to cash out. On that same exchange, you can sell your Bitcoin for US dollars and transfer those US dollars back to your bank account. Or you could send your cryptocurrency to someone else for goods or services. A lot of options. You could gift your cryptocurrency to someone else. I gave a very small fraction of a Bitcoin to my nephew for his baptism, and now he has his own little Bitcoin wallet. It was just a gift. Many things you can do with cryptocurrency. How do forks affect supply and demand? Okay, so I got to explain what a fork is. A cryptocurrency fork is when one cryptocurrency splits in two. What that means is, remember how I talked about the miners, and cryptocurrency is really just a ledger of transactions? Well, when there's a fork, you basically have a disagreement among the miners. And one of these happened in 2017 for Bitcoin. August 1st of 2017, two camps of miners had such a disagreement that one camp modified their software, and the other camp of miners said, no, we're not going to modify anything. And basically, you now had two groupings of miners running separate computer software to keep track of the Bitcoin blockchain. So what effectively happened is, if you had one Bitcoin before, now you have one Bitcoin on both blockchains. So what that means is, one of these cryptocurrencies now calls itself Bitcoin Cash, and the other one calls itself Bitcoin. If you had Bitcoin as of that date, if let's say you had 3 Bitcoin as of that date, well, as of the next day, you had 3 Bitcoin and 3 Bitcoin Cash, because you could now tell each separate set of miners to sell at a different point in time. That's what a fork is. How does a fork affect supply and demand? Well, it doesn't affect supply for either of those cryptocurrencies because it's really just a continuation of the same blockchain. As far as demand, once the fork happens, well, let me back up. Generally, before the fork happens, people know it's going to happen. So someone buying Bitcoin the day before the fork knows they're going to get 2 assets out of this. And someone buying Bitcoin the day after the fork knows they won't, they're just getting Bitcoin. They're not getting Bitcoin Cash in that example I just gave. So in general, after a fork happens, the price of that cryptocurrency will generally be split into 2 pieces. In this particular case, the one that's known as Bitcoin ended up being worth a lot more than the one known as Bitcoin Cash. Next question, do exchanges limit the amount one can convert from crypto to USD? If so, are there ways to circumvent the limits? Well, some exchanges have limits, some exchanges don't. Kraken is a good example of one that, as far as I know, I don't think they have a limit. Coinbase, I think, is around 50,000 per day. The way people will usually get around the limits is they will just go day 50,000 every day for 3 weeks, and that turns to $1 million or whatever it is. That's generally the way people go about it. There's nothing illegal or wrong with that, but that's just what people will sometimes do. Okay. That's all the Q&A questions. I got 20 minutes left. Let's see. I'm gonna jump ahead and continue with the slides just to keep moving a little bit. So, companies accepting cryptocurrency as payment. This here is not a complete list, but they're all companies you probably have heard of. You've seen them before. They have all accepted, they currently accept cryptocurrency for payment in one way, shape, or form. They will often do it with a payment processor, many of them, but others of them don't. Citron Cooperman, you'll see listed here. That's my firm, me and Pat's firm. We use a payment processor, and we've had several clients in the past pay in Bitcoin.
I was going to ask you about Mark. So clients have paid us in Bitcoin?
Yeah, I think we've had four clients that have paid us in cryptocurrency. If
Okay.
anyone listening to this call is a Citron client and wants to pay, just email your billing partner, and they can email this guy David Kells, who would send the invoice out, basically. Okay, so most of what I've been talking about has been Bitcoin. I'm going to talk about everything else blockchain can do. Blockchain can be used, blockchain technology can be used for all sorts of data storage applications and keeping distributed databases. Even Bitcoin skeptics think blockchain is amazing in general. Walmart is using blockchain. IBM is consulting on blockchains. It is a technological way to store a database in multiple locations, and it's a beneficial thing that a lot of companies are starting to experiment with. Even like JP Morgan Chase, which said, I think a while ago, Jamie Dimon called Bitcoin a fraud. They're building blockchain databases themselves. So even Bitcoin skeptics tend to think blockchain is fantastic, the technology. Altcoins, so that's the thousands of other coins besides Bitcoin out there. Some of them are a little more private, some of them are a little bit faster, some of them are linked to a company. There's no end to the number of permutations out there of different cryptocurrencies that are springing up. An initial coin offering is when a company will create a new cryptocurrency and sell it for money. That's called an initial coin offering, and many tech companies are doing them to raise money for software platforms, DeFi platforms, which I'll talk about a little later. That is a business use case for cryptocurrency. Tokenized assets. So a Bitcoin is just a Bitcoin. It just gives you the right to spend 1 Bitcoin. Well, other cryptocurrencies are out there that means something else. Like, for example, what if you were to create instead of issuing stock certificates for your company, you could create a cryptocurrency, and 1 unit of that cryptocurrency is equal to 1 share of stock in your company. Or you could create a cryptocurrency where each one is unique, and this particular cryptocurrency represents the deed to a piece of property. That's called tokenized assets. And even if you think the concept of Bitcoin is crazy, well, this is really just a technological way to eliminate having to deal with paper stock certificates or deeds. That's another use of this technology. Smart contracts are what I talked about a little before. You can integrate crypto assets into computer code so it can kind of enter into contracts and spend itself. The example I gave before is, what if you had an app that you just sign in, watch a video, and that video costs $1. You don't have to link up your credit card. You instead link up your cryptocurrency wallet, and every time you watch a video, it takes a little bit of cryptocurrency from you and pays the creator of that video. That is an example of a smart contract. You're getting video content and you're spending money. That's like a contract. It's it's like a legal consideration for a contract. You get something, they get something. It's just done with computer code. That's what a smart contract is. There are a lot of different ways to make money or try to make money with cryptocurrency. You can invest, you could buy and hold, you could day trade. Mining is another way to do it. Staking is another way to mine cryptocurrency. Basically, it just uses something called a different technology. Instead of using a big, powerful computer, you're instead putting up collateral to allow you to become a miner, basically. That's the concept. There are also companies out there doing brokerage and custody services. There are companies using tokens and crypto assets in their business model. Also, the last two, I'm kind of excited about the last two, because a lot of the complaints about cryptocurrency was that, oh, it's, why is it worth anything? It's a Bitcoin doesn't do anything. Well, now we actually have, starting kind of late last year, early this year, we actually have a crypto economy forming. So what is an economy? An economy is basically people doing stuff. We're selling services for money. We're making widgets and selling them for money. Well, I gave examples of some companies doing that where they accept cryptocurrency, but these next two items are actually people doing that with crypto assets. So think of all the different products that a bank would offer: loans, insurance products, mortgage-backed securities, options, all these financial services products that exist for dollars. Well, now they exist with cryptocurrencies. That is called DeFi, decentralized finance. That's that second to last bullet point there. And yeah, there's a ton of that going on right now. It's a very fast growing industry. So we now really have commerce happening using cryptocurrency. And then the last item here is also commerce using cryptocurrency. We have artists creating works of art, tokenizing them, putting them on a blockchain basically, and then selling those works of art as cryptocurrency tokens. A non-fungible token is a unique cryptocurrency unit that represents something else. They're generally used nowadays. What's currently been happening is people are using them as collectibles or creating art and using a token to represent that piece of art, and people are selling them on the Ethereum blockchain or other blockchains. So again, exciting, because we really have commerce. We have people creating works of art and selling them. That's commerce, and it's happening with cryptocurrency.
Hey,
People
Mark,
are also, yes.
Mark, before you go, let's just get to the polling question too.
Sure.
Just so if you advanced a few slides, there we go.
So Pat, I have 10 more minutes. Is that correct?
Yeah, roughly around.
Okay.
10 minutes. And as you can see, Mark is, like I said, he knows this stuff left and right. So, keep on coming with the questions. We'll try to answer your questions. And, you know, if you want to hear the topic again, maybe we can get Mark back in the future. And that's, you know, whoever's listening, if you have other topics you want to hear, you know, throw them in the chat or the Q&A, and you know, we can make that happen.
Okay. Yes, 60% of you are correct. Wendy's does not allow customers to pay in Bitcoin. Wendy's did send a tweet a few years ago offering to sell a hamburger for 1 Bitcoin. At the time, Bitcoin was worth $18,000, so I don't think anybody took them up on it. But no, Wendy's does not accept Bitcoin. Overstock.com does, Citron Cooperman does, Lamborghini does. All of which, all 3 of them actually use a payment processor for it. I'm pretty sure Overstock.com does. I'm pretty sure they don't accept it directly into their own wallet, but I could be wrong about that. Okay, going back 1 slide. So there's other ways to invest in this space without actually holding digital assets yourself. And I wanted to just present that to you folks in case you want to get involved, but you don't like this whole wallet mumbo jumbo. People are investing in funds. There's a number of cryptocurrency private equity funds, hedge funds out there. There's also something called the Grayscale Bitcoin Trust. That is it was originally a private placement, I think, but it's a limited partnership trust type asset, and you can buy it on like E-Trade, Charles Schwab. It's available to buy. There are currently no Bitcoin ETFs out there. There's rumors that there might be one in the near future. There's I think like 18 pending approval from the Securities and Exchange Commission. So we'll see what happens with that. There's also Bitcoin futures that are settled in dollars. So you can buy Bitcoin futures on the Chicago Mercantile Exchange. You buy them with dollars and they're settled in dollars. So you don't need to worry about holding Bitcoin. There are also many companies in the blockchain industry or holding crypto assets on their balance sheet. A good example is a company called MicroStrategy. They're a public company, and one of the things they did was they bought a lot of Bitcoin. So, and they're actually borrowing money and buying more Bitcoin. So their price moves very much in relation to the price of Bitcoin. Other companies like IBM, for example, IBM is very much starting to, not obviously, it's a very broad company, but they're really starting to do a lot of consulting in the blockchain industry. That's a good example. There are mining equipment manufacturers out there. Riot Blockchain is one of them. It's a public company you can invest in. And then there are also companies out there using blockchain or tokens in their business model. Those tend to be smaller startups, but they're starting to get retail investors. Venture capital is starting to look at them. Definitely a fast growing area. Okay, tax. The IRS is really cracking down on this. I'm not going to go into this in great detail because we're short on time, but they are working with Chainalysis. That's a company that specializes in blockchain forensics. They're sending letters to taxpayers. They have a question on the new tax return that asks every taxpayer if you had any financial interest in any virtual currency. They're really cracking down on this. So if you're invested, pay your crypto taxes. The IRS treats cryptocurrency as property. That's ever since they put out this revenue bulletin in 2014. If you receive cryptocurrency for goods or services or mining, that's taxable as ordinary income. If you buy cryptocurrency and then sell it, that's generally treated as a capital gain. We talked about forks briefly before. The IRS says when there's a cryptocurrency fork, the newly created asset is taxed to you as ordinary income. I kind of have an issue with that IRS revenue ruling. I think that might be challenged one day in court, but as of right now, that's how the IRS is treating it. Same is true for airdrops. Taxed as ordinary income when you receive it. So an airdrop is when you receive a new cryptocurrency. They're generally given out by companies that are trying to kind of advertise. Accounting. This is a very complicated area, and we do a lot of work in this for our clients. There's a lot of our clients, some of them have 20,000, 40,000 cryptocurrency trades on a dozen different exchanges. And that's tricky to handle because This is an example of what the transaction output looks for Binance. That's a cryptocurrency exchange based out of Malta. It says date, market, type, price. Coinbase, however, gives an output like this: trade ID, product, size, side, created at, size. These two spreadsheets look nothing alike, but if an individual were to buy Bitcoin on Coinbase and then transfer it to Binance and trade Bitcoin for another token, like this Wabi token, for example, here, you need to match up the trades in order to calculate your capital gains. So it's not easy to do, particularly if you're dealing with a lot of exchanges and a lot of different cryptocurrencies. So my firm and my staff spend a lot of time just dealing with this headache. There's programs out there that will help you with that, called like cointracking.info, bitcoin.tax, Luca. There's probably a dozen of them out there. If you need help with this, reach out to us, we can help. Tax savings. So people who've been investing in cryptocurrency over the past, in general, at least as of right now, they have a lot of capital gains that they're sitting on. One thing to think about with cryptocurrency is something called loss harvesting. If you have losses in other investments, you might want to sell those other investments before December 31st. You can potentially offset your crypto gains with other losses. Or if you have a particular cryptocurrency that you're down in, well, if you sell that, that can offset other gains. Currently, Bitcoin is not subject to wash sale rules. A wash sale is if you, let's say you bought Bitcoin at 65,000 at the very peak, and now it's worth 55,000. What you can do is you could sell it for 55,000 and then buy it right back and then take the loss. That's something called a wash sale. If you did that with stock, you're not allowed to deduct that loss because you bought the asset right back. With Bitcoin, however, Bitcoin doesn't fall into that wash sale rule because it's not considered stock and it's not considered a security. So that's another way to save on your crypto taxes that's currently not available to stockholders. That loophole might get closed end of this year, depending on the new tax regulations. But as of right now, wash sales are good to go on Bitcoin and any cryptocurrency that's not a security. Finally, donations. A lot of individuals are donating appreciated Bitcoin. The advantage of that is you don't pay taxes on the gain. And when you deduct it, you can deduct the full value of the appreciated property. So it's a big, big tax savings if you donate appreciated property. And that applies to stock too. So that's another trick for saving on your taxes if you have crypto gains. Polling question number 3. Pat, take it away.
Okay, everyone. Did this session meet your expectations? I gotta see. I better see 100% yes, Mark.
We'll see. I hope so. Fingers crossed. Ooh, there's a lot of questions. Okay. Oh, 98% yes. Very good. Very good. Okay. Couple more questions I'll try and knock out in the next minute and a half. I think the 6%, there was a 6% question about the 6% issued when a new blockchain event occurs and how that ties into the total market cap for Bitcoin. One person thinks they clarified, I think he meant the 6.25 new Bitcoin created. That's so as I mentioned before, there's 19 million Bitcoin. There will be 21 million one day. Every time there's a new block, another 6.25 are created. So the 19 million gets a little bit closer to that 21 million, but it will never pass 21 million. Any commodity or a technology company needs valuation, whether it's like oil or smartphone in USD. Why is a stable coin only valued as USD? Is not a Bitcoin backed by USD, or is Bitcoin really currency? Okay, so as I mentioned before, I don't think Bitcoin really, I wouldn't call it a currency because it's really, for the most part, not used as a currency. You can use it like a currency and pay for your Lamborghini with it, for example. But it's a shades of gray. I don't have a clear answer on that for you. Stable coins are pegged. An example of a stable coin I gave before that was pegged to US dollars. That's pegged to US dollars because there's a company behind it forcing it to equal $1. They keep money in a bank account. If someone wants to buy more of these stable coins, they'll sell them for $1. And if you want to sell your stable coins, they'll buy them for $1. So they're pegged to $1 because there's a company standing behind it. There's no such thing for Bitcoin. So the Bitcoin exchange rate floats freely because there's no one behind it. The same is true for the Chinese yuan there. It's pegged in a fixed rate to the dollar because China forces it to be. If China stopped that peg, the exchange rates would float freely. Supply and demand, just like any other currency. I think we're out of time. So I guess if you have other questions, feel free to reach out to me. My contact info is, I thought my contact info is on the last slide, but I'm sure Pat will make it available to you.
Good. And Mark, great job. Tremendous. Very knowledgeable. I learned a lot too, so it was very informative. And I hope everyone else thought it was very informative. As I said, if you want to hear other topics, please put them in the chat session. And if you have any additional questions, throw them in the chat session and I will get them over to Mark. Again, thank you everyone for taking the time out this afternoon to spend an hour with such a group. Thank you again. Mark, thanks again. Take care, everyone.